Recording in progress.
Hello, good evening, everybody. Thank you for attending today's webinar about REITs. Okay, followed by we also have a norm is a monthly AMA. We also talk about US market. Okay. Actually, there's a lot of questions posed, but I don't think we can answer all, but we'll try to answer as much as possible. Okay. Standard thing is a disclaimer. What I share with you is for knowledge and information only. It doesn't constitute a financial advice, as everyone is different. Okay. You need further advice, you can talk to us separately. And we are from Jurong East, we are from the Investor Center, Jurong East, located at Westgate Tower. In case some of you see and hear us for the first time, you are being invited to attend. Okay. And mainly in Philip, there are two accounts. One is called Cash Management and one is called Cash Plus. I think I mentioned this every session. Okay. Just that if you plan to buy shares and keep in CDP for the longest term, then use cash management account. Okay. Other than that, can just use Cash Plus. Okay, that's a normal advice I will give. Unit trust, any account is okay. And there's a smart part or called the money market fund. Okay, this return fluctuate daily. Okay, now it's overall 3%. So any of these account will have this facility. So which account also can be done. Okay, just some thing that should highlight to everyone. They may have a promotion next month for smart part for someone that's new to Philip. Okay, and the return is quite high from my perspective. So you have already have friend want to open an account. You can talk to us separately first. Okay, because you're able to get referral code also, and you also get referral fee also. And this is a QR code to open our account, and this is a Jurong East team. Okay. So for those who are not in our broadcast, Well Hero broadcast, you can contact our team directly. Okay, and they're able to add you in on that. Okay. So that's so much for our introduction. So now I want to, as usual, I pass to Chung Wei first. Okay, Chung Wei will start to talk about US market and also the US REITs first. Okay. Chung Wei, are you there? Chung Wei?
Yes. Can you hear me?
Okay, can. I stop share and you share your screen now.
Okay, hang on. Let me just try to play with these two. Where's my cursor? Okay, good evening, everyone. Can you all hear and see me?
Yes.
Aaron, okay.
Yes.
Full screen, can. Okay. Today I'm going to talk a bit more. Well, we'll start with, of course, the usual market overview, and after that, I'm going to kind of very quickly. I would try to cover as much of US REIT. Again, this is personal opinion, and as mentioned by Darren earlier on, this is my observation and my thoughts and what I think is moving. Please do your independent assessment. Without delay, I'm going to jump into market overview, and I'm sure many of them follow the market. I guess US key indices has, I would say the last 1 whole week, a couple of days it was up. It was down for a while, and then just because of the not so good as expected GDP result, which I think it came in at 1.6 versus supposedly 2%. It actually dragged down the whole market, and you can see that there was a big dip around here, and of course, even the other one. Hang on, I just need to move the screen for the small little, and also here. Okay, and actually, I thought it would rebounded up for the Nasdaq, or down was actually looking positive, and then suddenly it crashed down below even 100 days. So that's kind of worrisome, because Dow has been one of the weakest, but I think the last few days before Meta's announcement of their earnings, and because the earnings spend a lot of money on AI, it dragged down the whole market. Of course, if you look at the detail, tech and semi seems to be the one that is coming down quite fast. The other reason is also yield has been creeping back again. Yield used to be in the downtrend, and the last few sessions it has been climbing up. So that is also because of the previous week. I think the CPI data is showing some stubborn inflation that is kind of dragging the whole thing. The good news probably is oil is kind of holding and coming down a bit, but the US dollar continue to stay strong. So it's later I will talk a bit on the US dollar and the other Asian currency. But from all this, when I look at the fact that a lot of them is dropping below, is the MACD is below 0, RSI is below 50. All is not very strong sign, and it's showing some weakness in the overall indices. And if you go into individual counter by the Nvidia and Austin, some of them actually has adjusted quite a bit. There's two school of thought. One school of thought is saying that this could be what they call it, the technical adjustment since it has moved up so much, or even though the last few days it went up and then just yesterday it went up. The good news is yesterday post-market Google and Microsoft result was good. That could actually means that the market may open more positive. I haven't seen the future yet. I just came back home, so I haven't got a chance to look at the future. But this morning was showing that the futures was coming up. Okay. So with that, I also jump to the next slide. Let me see. Who is that? Okay, this meeting is being recorded. Okay, sorry. What else? Let me see. Okay, I'm going to jump to the next slide. Next slide. Oh, I have to remove my annotation. Give me a minute. Pen. Oh, the removal of the pen. All my writing. Clear all the drawing. Okay. So mega tech stock has been up quite a lot. If you compare to October 12, 2022, this has been creeping up very high. And in fact, if you look at this compared to 493 stock, this is done in January. Okay. It has been moving up. And you can see that the S&P 500, the majority of the upside is driven by the Mega 7 stocks. However, if I look at the current status, why is it not moving? Okay, sorry, the current status. Bear with me with my cursor because I just used another computer, so I was trying to play with it. From March, actually only Google is up, I would say. The other rest are all trending down. Even though if it's from January, January it has been creeping up, but on March actually onward, this has been coming down. And the other scary thing I was looking at is the volume is actually up recently, even though the stocks is coming down. So a lot of kind of a sign of people are letting go of this high-tech stock. Maybe it's on the high side and people is kind of taking a bit of breather. So again, tonight, got to see how Google is moving. If I look at Google current pre-market, I think it's jumping to 175 from 157. Looks like a good positive 11% jump. So maybe it will help the indices. But again, there's some sign that this whole momentum of Mega 7 tech stock is kind of losing the steam. So we shall watch this closely. It's one of those you can see earlier that itself is contributing quite a bit of the gain in the Nasdaq and S&P 500. So that's why we got to see how it progress. The next slide give you an idea of the US Treasury yield. Okay, US Treasury yield is one area that I watch closely, partly because it impacts particularly any company that uses loan or short-term or long-term, right? And REITs is particularly heavy on loan. It has been on an inversion. This month, I didn't share how much is the inversion and all this thing, but I just kind of get a look of the 2-year and 10-year and the 30 years. If you look at it, all of them are moving up. Okay, all are moving up. And in fact, the last time it kind of touches is 200 days or near is 200 days and start to bounce back. It seems to be on the uptrend. Not so good news for businesses because the cost of working capital will stay high to them. And yesterday, the what they call it, the 10-year is 10-year is always the benchmark for many countries central bank for their interest and everything. It actually hit way past 4.7 to 4.739, but actually before the market opened now it's dropped to 4.686. So the good news is a bit softening before the market opened, or rather at this moment now. But it has tested 4.7. You know, anything that goes up, it don't goes up all the way. It goes up and come down, goes up, come down, goes up, come down. But the trend is moving up. Looks like it may test last year or the what do you call that, the high of 5%. That's bad news actually for businesses and for people who has mortgage and housing. For people who buy T-bill, and definitely it's good news. I suspect it will also impact Singapore T-bill. I'm not sure whether how bad, how impactful it is, but likely. And of course, also usually when the cost of capital is high, the liquidity in the market will be lower. Liquidity in the market lower means less speculation or less playing in the market. So it has impact on business as well as speculation or the liquidity in the market. And this is the same for both 2 years, 10 years, and 30 years. All are moving up, which means that, well, I guess we will have to be careful on how it progress moving forward. Okay. So that's a bit on the yield. I will always watch this closely as I watch the market. Partly, it helps me to gauge whether whatever momentum up is it a short term or long term. And the other thing I watch also the inversion, whether it's kind of getting narrow or not narrow. But at this moment now, everyone is moving in tandem. Okay. Next slide. There is this thing called the Fed Watch. So the Fed Watch, I think this January or February when I have a December forecast, which actually indicated that very optimistically, wow, there's going to be about 5 cuts this year, 2024, as early as March. March passed, April gone almost, and May coming. The latest Fed Watch is showing that not so good now, because is showing that, oh, sorry, I pressed the wrong button. Is showing that it's only probably 1 cut. You see the circle area, right? Probably September there's 1 cut, and after that likely will stay until December. So from a 5 cut to 1 cut means you know, in the past, the momentum of stock going up was that, oh, they're going to be a rate cut in March. Oh, they're going to be a rate cut in May. But looks like the latest Fed Watch is showing that, oh, no, it's not going to be a rate cut now. The likelihood from the April outlook is showing that it's not going to be as optimistic as we would like to. Which is unfortunate because you can see that this is definitely not positive in for people that is hoping the rate cut will boost up the market, which is unfortunate. We may have to take a more conservative approach than assume that it will be there. Okay, that's kind of my takeaway from looking at this Fed Watch, which is another area that I watch carefully, whether the market is overly optimistic. I think from January to March, there was this hyper positive thinking. The market is moving positively up. So the rate cut is going to happen. So everyone is excited, and there's also the AI hype. Everyone's just gone into it. The next slide is also another key metrics that a lot of key investor or analysts actually talk about. This is called the the real-time sound rule recession indicator. It has been claimed to be 100% accuracy. 100%. I don't know. I'm not verified, but according to some people mentioned that it's pretty high accuracy. How do you read this? Is basically it's if the indicator is at 0.3. Sorry, my pen always not coming up. Give me a minute. Wait, sorry. See pen. Come on. Pen just doesn't like to come up for me. Okay, never mind. I'm not going to use my pen, but I'm just kind of talk over. Oh, it came out now. It's slow, my laptop, I guess. So the red line that I draw over here, this red line is actually 0.5. So what it's showing is that whenever it becomes dragging below, there's a measure that they measure between the few key indices. There's a key indicator. If this divided or the ratio came out to be more than 0.5 or it passed 0.5, usually a recession will happen. All this gray area, and gray area are the recession period. Okay. So what is have been showing is that we are creeping up. Last month was at 0.27 and now it's 0.3. Okay. So not sure whether this thing how accurate, but I think we have to watch whether this thing will turn to some issue in coming months and all things. But I continue to watch this to make sure that it's not an issue for the market. So the next slide is also tonight April PCE data. Sorry, April 26 is the announcement of March PCE data. So I think last month it was at about the main PCE is about 2. I think is 2.5, then 2.8 is a core PCE. Then there was expectation of 2.6. This was something I cut it out from the fact sheet. What's the expectation? And the Barons also reported there's some expectation. It's a bit fine, but I will, when you can, I may post it into my Discord later on. Oh, so I forgot to change my Discord code. Never mind. So this thing will be tonight's main challenge. I would say, is this going to go down? If it's going to go down, it's good news. So if this go down, of course, the likelihood of more rate holding at a high rate will be lower. But if suddenly today's result bounce out, then there will be even confirmed chance that the rate cut will not happen. Okay. So this is indicator core PCE and PCE, something that Jerome Powell or Fed always watch closely. So based on this, I think there is considerable risk, I would say, that because if you look at the oil continue to be high, I think there was some report of rental didn't really go down much and all stuff. So I suspect it will either hold steady or might actually creep up. So let's see how tonight's result going to be. So all this will add, the other issue is why I say the oil price also have an impact. This is more the reason, what they call market situation in oil price. It has moved up. The good news is after Israel and Iran, a bit of mutually shooting missile and drone and everything, it came down. So it broke the 20 days moving average, but it continued to be hovering around there. It's not coming down very fast. So the oil price is still hovering about 88. Let me look at it. Today, the price is about 88, creeping up a bit, 0.47% or something like that. So suspect because of the high cost, it will put pressure on the PCE, okay? And this is yesterday, I think, the World Container Index for the pricing. because of Red Sea, is still holding about, of course, it's much lower than the peak time at about 4,000 when there is Red Sea incident and all things. But it's not coming down to the pre-Red Sea period where it's only about 1,005 and all things. Still, this higher cost is probably going to cascade down. And if you look at Iran tension, is still there. Although they are a bit of wayang like that. I'm not sure whether mutually putting their position that, hey, you shoot at my embassy, so I got to shoot a missile to you. Then now, okay, you shoot back there. Then, okay, I also shoot back to you. But then whether it will escalate out of control, especially I think Israel is still going to go ahead with Rafah bombing and all things. So OPEC and I mean, this will create a bit of Middle East tension. So this higher cost will create continuously pressure on the what they call it, the inflation. Okay, so that's kind of my thought on this area. Next slide is let's see. Okay, see clear all. Okay, next one is more on. I look at the this is a US dollar to the various currency. I started the bar chart is with the Japanese yen. Recently, Japanese yen, particularly from 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 end of March or April, beginning of April, it started to creep out. Okay. This is by percentage, but basically now you should know that the Japanese yen is about 155 to one US dollar. Let me see, the latest number is, what is it? I think it's around that area. And so that's kind of US dollar to Japanese yen. Yeah, 156 today. Oh, it went up even higher. So the Japanese yen actually depreciated more. But I noticed there is a bit of all Asian currency are being affected. And I noticed that these are all the different currency. I have Vietnamese dong is also, up. I mean, basically US dollar up means Vietnamese dong is down. And Korean also, Malaysia also, Singapore also, and of course Chinese yuan is the lowest in terms of the movement. So it's interesting that this is impacting on quite a bit of Asian currency. Is this a repeat of 1997 Asian financial crisis? I'm not sure, but I think we should watch this closely because it will have certain impact to the equity market or at least the Asia investment. Okay, so just my thought around this area. The the next one is I look at the overall geopolitical situation. It's not so healthy too. If you look at it, the TikTok ban, and then the South China Sea, you have all the various, I think US just deploy some mid-range missile systems in Philippines, which is not good news, of course. And of course, Blinken is in China now. I guess US and China is going to have a serious talk. Of course, China is breaking away their tech sanction with their latest Huawei P70 and Pure 70 and all those things. But if you look at Middle East, it's also not as peaceful. The tension is still there. Likewise, Ukraine and with NATO getting involved with their big 3 months exercise, and the US just released a huge bundle of war, what they call that, support and the aids to Ukraine as well as to Israel. I think the war is not that peaceful. Any minor misstep can be serious consequences. So I think we do need to invest cautiously. This is kind of my view for the moment now. Might be wrong, but it's always better to be safe than to be sorry. Okay. That's kind of my summary of current market situation. I would say May and June is something we have to tie over closely, watch it carefully, and see how it's going to evolve. I suspect US is pushing for quick closure on some area like the Middle East, Israel, Gaza area, but whether it's going to close peacefully, looks like maybe US is under the mercy of Israel, how it's gonna move its strategy in Gaza, while Ukraine is a negative drag to Mr. Biden. If he loses, it's going to impact his presidency. So he's putting whatever necessary to keep the war going, which is a bad news for nobody likes to have war. So I think let's don't hope they bring this war into Asia with this situation in South China Sea. I mean, that's kind of scary. I think always be alert of what's happening in the market. Okay, so I'm going to jump into US REITs. US REITs are always impacted by interest rate, definitely. As interest rate is higher, they will impact its loan costs. I kind of pull out the last time the top US REITs in market cap. So if you look at all this chart here, most of them are down. Okay, most of them are down. Of course, there are Well Tower is up, which is about a healthcare thing. I will show more slide on that area, and Realty Income also, which is also related something to whatever method. But these are mainly down, which is quite interesting that the rates does impact them. Okay, so that's kind of the broad picture of US REITs has been affected. Let me just move to the next slide into individual or rather the summary, I would say. I did a summary of various what they call it, key company. There is some of them that's not in the earlier list, partly because I noticed some of them might be of interest, so I put it in there. Because looking from different sources of data and all things. But you notice a lot of them, their PE is very high. Like this IT data one is crazily high, so I didn't short this to deep dive further. There are some of them is mainly very unique cold chain business. So it's kind of but this guy which I talk about, Well Tower, is at 178 PE. Although it's one of the earlier slide shows that is it's what they call it, it's one of the growing up one, the pricing. But if you look at the PE is something that we need to be watchful of. The other area I also look carefully is whether there's enough free cash flow to keep their business going. Okay, because free cash flow means you have enough capital or cash flow to pay for the thing. The debt to equity is another area I watch closely, and I noticed a couple of them is crazily high. Like that's why I took out. I never even look into this 67 times of equity. I mean, anything above, I would say above 4 or 3 is actually I even personally for my other equity investment I look at 0.5. So a lot of these are above 0.5 really. So it's still on the high side. Price to book value. So that means basically the current price versus its net book value. I also highlighted in red are those that is not so good. Okay, so this again is personal opinion, and feel free to take a snapshot, but doesn't guarantee what is right. It's just giving you an idea of what are the things that is clear of my thought around this area. Oops, how come it's not clearing all my drawing? Okay, never mind. Next, Prologis. So Prologis is one of the top one here. And I kind of like it partly because it's one of the biggest, 97 billion. I used to be in the supply chain operation area. I run for Nike, I run for Mass Food, and I run for HP. So I run for 3 MNC before I took up a more semi-retired job on financial advisory. So I used to run the operation end to end. Prologis is one of the warehouse partner that we used to work with. They run pretty much initially they also one of my China warehouse, but they only do for our looking for the warehouse space. In the end, we buy back or we bought the land to build our warehouse. So, but we do I would say pretty professional. I would say. However, if you look at the pricing, or rather, its earning is pretty bad lately. The balance sheet and all things. So flat revenue. Debt to equity is creeping up if you based on earlier slide, which is not so good. So that's something that I would also, because of the chart coming down, I would also be very mindful of when to invest in it. Okay. Then the next one I would say is Equinix, which is an IT center, cold space. Yeah. It has I think this may be something we can consider. But again, I think the what do you call it, the PE is on the Equinix is on PE is very high, 73. You can see. So although it has come down, but is it the right price to go in? Well, I guess everyone can always think that IT center with a lot of AI and all things, is it more in need for this thing? I kind of summarize a few quick notes: improve income, free cash flow, although deep, but it's still there, still positive. But of course, if you look at MACD is negative, then of course, technically a bit on the weak side. I will be careful when to go in. Again, this is sharing what's the key area or key stocks that can consider. I'm mindful of my time. I better don't take too much time. Well, Power, just now mentioned about it. This is the one that is the PE is crazily at 100 over. It's a healthcare senior home. Very high valuation. I should say very high, not just high. Their EPS, ROE, and ROA, when I go deeper into the detail, it's all dipping. But the beautiful part is, if you look at the chart itself, it's continue to go up. So it's a very positive momentum coming up. Probably there's more and more old people. There's more and more people who need this kind of services. And if you look at the quarterly report, the revenue is going up, but of course the earning is not there. The income is not growing up as fast as it's supposed to be, although the balance sheet still looks quite reasonable. So again, high valuation. So whether you want to go in or not, something to consider the implication of it before you go into it. Prime, this is SPG or called Simon Property. It's quite common. A lot of people, I have seen this or I heard about this property for a long time. A lot of people invest in it, but it's commercial space. There has been a lot of talk about commercial space is because of the work from home, because of the change in the way business is growing and all stuff. Commercial space has been hit by retail, what do you call that, traffics. So pickup is lower and all things. So all these are impacting them. Technically, the chart still looks corrected down a bit. Is it a good time to go in? I find that the debt to equity is high and continue to go up is my concern, which means that their interest impact might be there. So if I look at this chart, SPG, if you look at his debt to equity is 8.89, which is very high. So something to be very careful, which means that $1 equity, you have $8 debt, or almost come to $9, extremely high. If they cannot get more borrowing, or they cannot turn around their cash, or the rental keep going down, there's not enough cash to come in to impact them, they will be in trouble. So that's something, although their cash flow seems to be still okay, but just always be safe than sorry. Realty income, this is a mixed space. Mixed space means they have commercial, they can office space, they have all kind of different things. Pretty interesting, steady income stream. Again, margin drop, lower PB, but debt to equity is up also. So that means they are absorbing more debt. But the chart wise, I would say, because MACD is close to up above zero, more positive momentum, and because of mixed space, probably less impactful to itself. Again, if you look at earlier chart, the PE of this reality is, I think, is 42. Still on the high side, I would say. Okay. Next slide is basically digital reality, which is basically what they call it, data center. This is also another favorite a lot of people like to buy. Again, revenue continue to steady and there, but I think the last quarter it actually dipped and the earning actually went to almost very little. Net margin came down quite a bit. But again, could be seasonal, so we need to see the overall. But the trend wise also slightly better, not as good at reality, a bit negative. But again, all interest because of the high yield going up, all of them are having some sign of dropping. So maybe we can wait and see. But this growing revenue is still there, except for last quarter it's a bit down. So have to watch it. Income drop, accessory, the gross margin also drop. Okay, but the good news is the debt to equity drop. So debt to equity drop means you have less what they can impact on your debt situation. So that's kind of the situation that I see. Oops. This is another different type of REITs, which is more on forestry, which is like timber, forest, and all that. I put here just more for information, I would say, because it's one of them that is the lowest debt to equity. It will benefit on the economy recovery, but if I look at it now on currently is 27 PE, price to book reasonable, debt to equity using 0.5, very positive. There's also a bit of drop on free cash flow, but it's something we can watch if there's an economy recovery, the timber use will pay. You can see that the revenue is down also a bit on that area. Okay. So that's kind of the other area we can look at. Next one is called the invitation home. So this is single home rental. In US, when called single home rental means like a small house that's been rented out for people. This one is quite interesting. If you look at it, it's oops, I don't know what happened to job. Anyway, is seems to be hovering and maybe able to move up. Debt to equity less than 1. Stable income. You can see this is pretty stable. The income, it doesn't move a lot. So maybe something that could watch. There's another one that I didn't got a chance to put in the slide here. It's called ABB. It's also, but it's more the premium single home income. That one I didn't got a chance to do a slide on that, but there's another one that could be an option. There's so many options that you can consider. Okay, next, Omega Healthcare, which is another healthcare related. This one seems like healthcare related is more resilient during this period of what they call interest rate, because people still have to go to their, the old folks home and all things, or healthcare needs and all stuff. So it has been holding there. Again, the debt to equity is my concern. It's about 1.41. Although it's flat now, it actually dipped down from the last round we look at it. Just that, is this the best price to go in? Something we have to look at it carefully. And of course, whether the dividend can cover. One thing, there's some question about dividend and all things. In US, anything that's related to US, there is the dividend will have the 30% government tax on it first, second way. Okay, so that's something that you have to be mindful of. Okay. Next, Regency Center is a commercial mall. I think this commercial mall were very similar to earlier on SPG, is under a lot of pressure coming down. So I won't go more deep into it, but basically, this one looks pretty good because I pick it up because there's a pretty steady revenue and the income also quite steady. So I think the commercial mall they have is probably in a better area. That's why they didn't affect it that much. Okay. Then let's see what's next one. Is called the Cold Chain. Cold Chain again is just for your knowledge. It's a pretty bad company now. It's losing money. So Just for your knowledge, there's this thing called cold chain. Basically, it's like to ship all those freezer goods and all things. So I won't go into detail. This the other one, public storage. I used to pick up another one called PSA, another company, which is also public storage. But I noticed between these two, this one seems to be a better one, in terms of the fact that its revenue is growing quite fast and its income is still okay. Self-storage space, debt to equity also has improved. So I kind of pick up this one instead of the earlier list called PSA. In the big list that I sent out, there's a company called PSA. So I pick up EXR as to share on here. Yeah, that's kind of a bit of a quick on the REITs on US. I'm going to share a bit more on the last slide is about ETF. If you don't want to buy REITs, you want to buy ETF. There's 7 best REITs ETF you can consider. These are some of them, but I noticed some of them are not just purely in US, but also in other region. But I pick up VNQ partly because it's one of the most biggest capitalization. I think it's VNQ. Let's see. I think it's how many billion? 60 billion or what? Let me see. AUM is 31 billion. The AUM is 31 billion. So the bigger you are, the big amount of what they call portfolio that they own it. So and this is just one of the VNQ. I use investment.com put it out. Again, of course, if you look at the indicator, whether time to buy or time to sell, a lot of them are showing strong sell because of high interest rate. Again, this is just for your reference on what are the stocks that you can consider and all stuff. Yeah, that's it. So if you want to invest in anything, of course, you have to watch what you want to look at. Sorry, I didn't update this QR code for my Discord, so you won't be able to scan this and go into my Discord. Probably I have to send another one. If you are interested, maybe you write to me, and then after that, I can share my Discord, which will share a bit more of the information on the daily or almost quite frequently on the market itself. Okay. That's it for me. Pass it back to Mr. Who is it? Elijah?
Okay, thank you, Chung Wee. You all got any question, you can just type on the chat. Okay.
Oh, I didn't turn on my video.
Okay. Before I pass to Elijah, maybe I just want to answer one very good question that someone had posed, okay, on share buyback. Okay. Before I talk share buyback, this is the QR code for you to give us feedback and comment, okay, on what future AMA you want to talk, topic you want to ask cover. Okay. So maybe I want to talk about this topic called share buyback. Okay. I believe a lot of people will know that in US, there's something called stock buyback. Okay. It's a very popular thing in US. In Singapore context, it's not that popular. Okay. So what does actually a stock buyback do? Means that actually the company go to the market to buy back the shares. Okay. So this will reduce the number of shares in circulation in the market. So thus this will improve the earning per shares. Okay. It will increase the EPS of the shares, and this will indirectly improve the company share price. Okay, that's what a share buyback is. Okay. But to do share buyback, you need one thing, that you need to have money. Okay. If you don't have money, you can't do share buyback. And you can see a lot of companies, big companies, okay, they do share buyback. Okay. For example, the popular one is like Apple. Okay, this is taken from Molifu. So Apple have do share buyback every year. Okay, every year they do share buyback. Okay. And over the past 10 years, you can see that the number of share buybacks is the current value of Netflix or JP Morgan Chase. You can see that they buy a lot of shares back over the past 10 years from the open market. And this will reduce the number of shares in Apple share in circulation. And this will indirectly create a positive to share price. Okay. But why they can do that? Because they got a lot of money. Microsoft also do share buyback. Google also do share buyback. Google don't pay a single cent in dividend. but they do share buyback, and then the share price will able to continue to go up. Okay. Okay, this I'm going to talk about ESR logo later. Okay, because there's a question posed on that. Okay, so that's it. And Warren Buffett himself liked share buyback. But do think he got one question. For a good company, that is a catch. Okay. A good company do share buyback is have a better long-term value generation than dividends. And this is why Berkshire have a way, don't pay dividends. They only do share buybacks. And you can see Berkshire have a way share price has started to go up along the way. Okay. But this is talking about stocks. Okay, this is talking about stock where they have money. Now, let's go and look at REITs per se. Okay. So for REITs wise, right? Okay. If the share price will go up, the market cap supposed to go up because share buyback is supposed to boost up the share price. So the market cap will not be affected. For example, you can see Apple, the market cap keep on go up, and every year they're doing share buyback, and you can see they become $1 trillion companies. Okay. But that is for stocks. But come to REITs, that is another separate story already. Okay. First, you must understand how the REITs work. So a REITs need to pay 90% of their income as dividend. Okay. So they hit 90%. So how much they left? 90 to 100. Some of the REITs pay 100%. Some of the REITs don't keep a single cent. So those that more stingy one, they pay 90%. Say they only have 10%. Okay. So they have what? Limited cash. Okay, they have limited cash. And what other form of cash they may have is if they were to sell a properties. Okay, if they sell a property, sell at a profit. So because REITs are also like property agent like that. If they make a profit from selling a property, they call divestment. The cash they can keep. Okay, they can keep and don't need to pay as dividends. Because the 90% is only cover rental income. Okay. But a lot of them will choose to pay out as dividend also. Like some of them will choose to pay out like Parkway Life, they always take some of the positive selling of the sing home, then they pay out as dividend because that will boost their dividend. So by doing that, so we can look at the financial statement of REITs, right? So they got very little cash. Then how come they can do share buyback? So that's something that you need to think of it. Okay. And in Singapore, there is 3 REITs that do share buyback. Okay. There's 3 REITs do share buyback. And one is called the DigiCore, US company. So follow US star. Okay. That one is Keppel REITs. And the other one is ESR. Only these 3 companies. You can see the big boys, the Maple Tree family, Capitaland family, they don't do share buyback. Okay. So what is the impact of the share buyback? So you just go and see this. I look at DigiCore. You go and see their. Okay, it's not. I cannot say good or no good. You go and see their company announcement. A lot of share buyback one. Okay, look like they are more interested to buy back shares rather than run the business. Okay, every time share buyback, share buyback, share buyback, share buyback. Okay, then the question is where they get the money from? Where the money from? And what is the impact of share buyback for REITs? For REITs. Okay, this is Keppel REITs. This is a Keppel REITs mandate. They can say that they were able to buy 10% of the shares from the market. So what does it boost? It boosts what? It boosts their NAV. Wow. Because people will also look at NAV. NAV will go up, right? It boosts their dividends. Correct? But do you see this thing? Gearing will go up. Gearing will go up. Why gearing will go up? Because they got no money to buy shares. And what they do? They go and borrow money from the banks to go and buy shares. Okay. So because they don't have enough money. Because for REITs, they don't have money to do one. So what they do? They go and borrow money to buy shares. To buy shares. So just like got no money, go and bank, borrow money, then to buy shares. Okay. So to me, it's not, I don't think it's a good practice. Rather that they should focus on how can they increase the NAV and increase the DPU by doing the proper way. And rather that to me, this is something like financial engineering. Okay. Same thing at ESR. they tell that, oh, they'll do a share buyback. You see, they'll tell, wow, I will increase your dividends. But worst part, the NAV never go up. Because the share price never go up. But your gearing will go up. So the gearing will go up. What does it mean? Means that if you say they want to buy property, they will need to call for right issues, preferential shares again. So similarly, they buy back the shares, then they need to reissue back again. Okay, so it defeats the purpose. Unlike Apple, when they do share buyback over the years, you can see the number of Apple shares in the market is getting lesser and lesser and lesser over time. It's not increasing over time. But for REITs, they do one time share buyback. To me, it's like financial engineering. Everything looks so good already. Or investor happy already. Then after that, they say, I want to buy properties. I issue more units. And your gearing is up already. So that is what REIT share buyback is all about. And they are very transparent. They tell you where they buy, but nobody reads. Okay. The source of fund, like finance this CSR, there will be internal source of fund. That's where they pay out 90% of dividend, left 10%. And if they sell property, they make money. And external borrowing. That means they go to the bank, and at this current market juncture with a high interest rate, they go and borrow money to buy back shares. Okay, so it's just to same thing. Capital Corp, they'll tell that they'll do capital raise, they'll tell external. So that is something just to take note on that. So to me, that a REIT share buyback look very funny where they don't have money to buy shares, and they need to go to the banks to borrow money to buy shares. Okay. I would rather that they should focus on how to do a proper management of the risk, increase the distribution and buy better properties, rather than go and buy a lousy property, then do a share buyback, artificially jack up their NAV, jack up their dividends, but at the expenses of increasing your gearing. Okay, so that is on the share buyback things, and only 3 REITs in Singapore do this. Okay, one is capital REITs, and one is ESR. ESR just started last year. I think they see Digital Core keep on doing. Okay, so they just copy. Digital Core have been doing that for many years. But I look at the performance of the REITs. Okay, Warren Buffett said that good company do share buyback is good for generation. Okay, the emphasis is must be a good company. Okay, so that is on this part. Okay, now I want to pass to Elijah. Okay, sorry I can't talk much because I'm now having fever. Okay, so I get Elijah to answer most of the questions. Okay, Elijah, are you there?
Yes. Okay, I'm not seeing my screen. Okay, we realize that some of you may not be very familiar with REITs, so I'm just going to go through some REIT fundamentals. Shouldn't take more than 10-15 minutes, and then we'll be answering the more popular questions that you asked, because you asked a lot of questions, and I don't think it's possible I would answer every single one, but we do see some recurring questions, so we will definitely try and answer those. Okay, so for those of you not familiar with REITs, just really what is a REIT? It stands for Real Estate Investment Trust. So basically, it invests in real estate assets. Okay, so it's run by REIT managers. Okay, so these are the people who are actually running the show. Okay, and of course, REITs, they trade on Singapore. Okay, we'll be focusing on Singapore listed REITs today, which we have 35, and I think the market cap. Okay, this number maybe not so accurate because I know the REITs market is down a bit in the past few weeks. Okay, but that's I think part and parcel of investing, right? You have ups and you have downs, and now just happens to be a down period for a REIT. Okay, so that's what a REIT is. And basically the structure that allows them to pay such high dividends, the fact that when a REIT, my pen, okay. Hang on. Okay. So when a REIT borrows money to buy properties, the only thing they ever repay is just the interest. This is not like how, let's say, you as an individual buy a property, you take a loan, but you pay back not just the interest, you also pay back part of the principal to go along with it so that eventually you can clear off the loan. This is not the same for REITs. Because where do you come into a picture as an investor? You invest in the REITs and you expect to get dividends, but keyword here being that it's not guaranteed. It's an expectation that most REITs will pay. In fact, most REITs used to pay quarterly, but a lot of them have since changed to semi-annually after COVID hit. Okay, and what does the REIT itself do? They buy properties and of course they collect rental from that. Okay.
So that's the basic structure of REITs. Now, the question that a lot of people that some people ask, and a lot of people may not fully realize is, are REITs safe? The answer is no. These of course, I know these are 10 big examples, but the fact is, a badly managed REIT ends up like that. Like you could lose, well, a lot of money, put it that way. Okay. But of course, well-run REITs in general should remain well-run for the foreseeable future. But of course, whoever's running the REIT, if let's say they retire, they replaced by someone else, and that person is not competent, it can also spell the beginning of the end for the REIT. So as an investment, I would say that you always need to review regularly and expect that, of course, when times are down, your REITs are going to drop like now. That's going to happen, okay, because that's more of not the REIT's fault, but in general market situation or general market conditions, whereby Feds have already indicated they won't be cutting interest rates. So that's definitely going to have an impact on the REIT pricing, okay, at least for the short term, for a little while longer. Okay, so remember, our REITs are definitely not safe. You can also, another famous example, Eagle Hospitality Trust. I know that one's not really a REIT, it's a stapled trust, but Eagle suspended, right? So that's really bad for anyone who got into it. I hope now you have. But yeah, any investment can never be said to be safe. It's just what kind of risk are you taking on, and are you comfortable with that risk? Okay, so the structure of REIT, I won't touch too deeply into it, but basically where you come from, you are just the unit holder of a REIT. Okay, so how the REIT runs is up to the REIT manager, the property managers, okay, and of course what kind of properties they have. This is really basically just a simplistic flow chart, okay, and I think the best way to put it in perspective is to use this. Okay, some of you, actually I believe most of you will have heard of CICT, Capitaland Integrated Commercial Trust. So they own all these properties in Singapore, retail, integrated developments, and office. You can see that it's very heavily weighted in Singapore, but of course they have some properties overseas as well, Germany and Australia. So ultimately, the one thing that I would say you will want to look out for is who are the managers, who is the sponsor of the property, and these are two very key factors. If you don't like the sponsor, or the sponsor is not having a substantial holding of the REIT, right, then you would want to be careful. I can't say it's a bad thing, but you want to be careful when buying such REITs. Ideally, the sponsor of the REIT, which is basically the Akong, so to speak, should have about a 20% stake, give or take a bit. I think that would be a good number to ensure that they are vested in the outcome of the REIT, right? Because if the REIT fails, they also will suffer a kind of a loss. Okay, so I think that's something very important to look at. So sponsors, good sponsors are pretty essential. Okay, but a good sponsor cannot fight the market. So if the market is down, even you have a good sponsor, the REIT also will crumble, at least for now, right? Okay, so why would anyone want to buy REITs? I would say actually there's a few pros, okay, but of course there are cons. So REITs are really quite affordable. You are able to, not that you should, but the minimum number of shares you need to buy is 100 nowadays on SGX. So you want to buy Ascendus, you just need $250, $260, give or take a bit, and then you can actually get 100 shares of Ascendus. Okay, but this is not counting your brokerage fees, your clearing fees, and things like that, which may take the cost up a lot more. So I would generally say that if you want to buy REITs, okay, you still need to put in a sizable amount, a four-figure amount. If not, the transaction cost will eat into your return. Okay, so that's something to think. No, okay. Second thing is, of course, REITs are more liquid than property. As anyone who has tried to sell a house has experienced, like either you can sell it or you can't. And if you can sell it, it moves fast. If you can't, your property might stay on the market for very long before it gets sold. So a REIT, however, because it's traded on the exchange, right, you always have volume. Okay, disclaimer, you always have volume if you'll be able to move it, you'll be able to sell or buy it, provided you put up a price that the market is looking for. Like CICT is, I think it's around $2 now. So if you're looking to buy it at about $2, sure, you probably could get it. But if you want to say, I want to buy cheap 180, sorry, you will have to wait. The price isn't 180 now, and it might come down to 180, but you will definitely have to wait. Okay, so if you're willing to accept whatever the market's trading for, you definitely have liquidity there. Okay, diversification, this cannot be stressed more. enough the importance of the importance of diversification gives the REIT the ability to withstand any impacts lah. So for example, Ascendas REIT has over 100 properties. Even CICT is 20 plus 30 properties around there, right? So if anything happens at one of the properties, okay, they are operationally they're not tremendously impacted. Compare this to, for example, Landlease REIT, which when it launched had I think only 313 Somerset and one other property in I think Italy it was. So imagine a REIT with just two properties. Something happens to one property, that is like a 50% impact on their operations. Okay, so and of course, as an individual investor, it's really hard to buy more than just one property. Even you have funds to buy commercial properties, it's not going to be easy. So REIT give you the diversification you need. Okay, and of course, in Singapore, all income from such investments are tax-free. So I think that's another good plus. Unlike US, where Chung Wee has mentioned that they are subject to a 30% tax, right? Okay, and of course, since REITs need to pay out 90% as mandated by law, okay, 90% of their income, your yield will generally be higher than other classes. Okay, contrast this to the banks. Local banks actually not too bad now, I felt, but most of them don't pay off 90% lah. They're only paying like half, but they still can run the yield about 5% lah. Okay, but REITs, a good REIT, at the prices that you're seeing now, you might be able to get 6-7% yield. Okay, as mentioned earlier. Okay, but of course there are also cons. REITs are very highly leveraged. Okay, so if they want to expand and they are too highly leveraged, they have simply no capacity to buy new properties, and REITs always want to expand. So you need to understand that leverage comes with risk. So if market conditions turn against them, then that would be there'll be a problem there. Okay. Market risk, okay, again, I need to stress, it's an investment. No REIT is buy and forget about it. You still need to monitor from time to time. Okay. And as I mentioned, just because a REIT is good now does not mean it will stay good forever. You do need to watch over it. Okay. And if you can't, or let's say you are approaching a retirement and you don't want to have to deal with this, right? Then you may not want too much REITs in your portfolio, if any at all. Okay. There's no guarantee of cash flow. Okay, REITs have suspended dividends before, so that there's no guarantee. So I need to stress out the payouts, right? Okay, there's the guarantee of a payout is very important in retirement. Okay, some of you ask about anything good for retirement, any REITs that are good for retirement income. Generally, REITs do pay, right? But if exceptional events occur like COVID, they don't pay. Okay, you will be struggling for money. Okay, so just remember that guaranteed cash flow is something that I think you must also have. It's not just having an investment risk. Dilution risk. Okay, so sometimes REITs need to raise money to buy new properties, and then in that case they will call for funds. For retirees, this can be a problem. Okay, because if you don't want to get diluted, then you definitely need to participate in this kind of right issues. And then if that's the case, you have to fork out money. Instead of you being paid by the REIT, you have to pay the REIT. Okay. And then concentration risk, this one of course depends on where the REIT is focused on. So let's say hospitality REITs all focus on hospitality sector. During COVID, they did really badly. So you don't just buy one REIT. You need to look at other REITs across various sectors as well. So that's the general idea. So what type of REITs we have in Singapore? Okay, you got retail REITs. I think all these are pretty familiar names to most people, especially Frasers. Some of them maybe you haven't heard of it. Okay, but I think Frasers, most of you would have. Paragon, yes, the one in Orchard Road. Okay, so retail REITs, we got office commercial REITs. These are just some of them. I think Darren mentioned Capital just now, and then of course we got a few others like Manulife and so on and so forth. Okay, industrial REITs quite popular. Okay, Ascendas, the biggest one here. Okay, and then of course some of the popular ones that you can see Mapletrees are there. Okay, the rest have a slant that's not really Singapore. AMC Pack is still actually Singapore. Okay, and then we have hospitality. Okay, these hospitality REITs would it's a very tactical play. So even right now, I am wary about them. And then, of course, you have specialized REITs. Capital DC was very popular at one point, but now it is coming down. Okay. And then you got diversified REITs, which maybe is a better bet in terms of if you are not quite sure which sector to bet on, diversified REITs will give you a little bit of diversification in that sense. Okay. Most people will be familiar with CICT, Fraser, Suntec. Okay. If you have risk-taking appetite, okay, then maybe China and Europe. Okay. This one is largely Singapore, but there's also some holdings in Hong Kong, which has pulled it down in the recent year or so. Okay. Then of course, healthcare, there's only two, but in reality, there's only one that's worth buying, and I think that will be Parkway Life. Okay. So how do you evaluate the REIT? Of course, everyone has different views, but I would say the portfolio is important. Where are the properties, right? So for example, this is CICT. Okay, their properties largely in Singapore. Okay, are you comfortable with these properties? Are they, do you like what you see? You have, then you can start considering from there, right? Okay, and then for properties that are, this is Keppel REIT. Okay, so you can see that there's some holdings in Australia, largely Singapore, and then I think a few others scattered. There we go, South Korea. Okay, so do you like this composition? Do you like this makeup? Okay, and because if you don't, then my answer to you is just don't invest in the REIT. If you're not comfortable with where it's invested in. Okay, so for example, I think Mapletree Logistics is actually quite heavy in Hong Kong and Greater and China. That's about 40% in Hong Kong and China there. And that's why it has taken a beating. I think investors are still not very confident about the China market for the time being. And then even Singapore, they're only like 20%. That's for Mapletree Logistics. All right. Okay, so I did mention about the sponsor just now. I think having a strong sponsor would be important for REIT. And ultimately, I guess you can read what is on the screen. But the key thing is if you are not a very big risk taker, okay, I would just highly suggest look at REITs that have very good sponsors, namely the Capitals, the Maples, and the Frasers. Okay, these would generally be a cut above the rest, okay, in terms of the sponsor backing. Okay, and generally I found those REITs to be quite okay, long run, okay, but okay, long run, but you must also be able to take the swings. Okay, evaluating them, there are a few things. Okay, so for example, NPI, net property income. Okay, so you want to look at this. Okay, are they able to generate increasing NPI over time? Okay, but even then, after net property income, you still need to consider a few other factors. For example, the DPU. Okay, so is that also climbing over time? Financial engineering, that's another one. Sometimes when a REIT is newly listed, okay, then you may have a there may be some financial engineering. I can't remember which REIT it was, but some years ago when one of the REITs was listed in Singapore, the sponsor actually committed to top up the payout, at least for the first 2 years. So question would be, okay, great, you get high payout, but then what happens after that 2 years has passed? For example, then your payout will start to drop. Okay, so just beware of such things. The lease expiry is also another thing. You will want to make sure that your the tenants in the REITs don't all have their leases expire at the same time. Nicely spaced out. And also on top of that, no single tenant has too many, makes up too much of the revenue of the REIT. Okay, so I think that is another important thing to take note. Gearing, okay, if REITs have to expand, we don't want too high a gearing. Okay, too much debt is actually very dangerous for company and investors. Okay, and for example, because the gearing is a percentage, right, and it's based off the valuation of the REIT. So if the property value of the REIT drops due to whatever reason, okay, then the gearing can suddenly just shoot up and exceed the mandated maximum of 50%, and then you will have a problem there. Okay, so of course, another thing to consider is what kind of loans they have, how much is fixed, how much is floating. That will also impact the gearing. Okay, interest cover. So how much capacity they have, how much of their interest payments, how many years rather of their interest payments that they can withstand. I would say 3 or more is a good number to look at. And of course, if it's lesser than that, you have to be careful. Okay, and then lastly, of course, future prospect of the REITs. Are they intending to expand? If so, where? Okay, and REITs always have to expand, so you want a REIT that ultimately is looking at growing their property base over the years. Okay, now you can't decide. We also have REIT ETFs. There were some questions about REIT ETFs as well. My take is you look at their yield, actually it's not extremely attractive. But of course, you buy a REIT ETF, then of course you do not have to worry or think too much about it. You are just basically just buying into one single collective investment scheme that invests in the ETFs for you, and you don't have to worry about rights issue, because if it comes to that, the ETF will actually take care of that for you. Okay, but take note, expense ratio of REIT ETF can be high. I think some of you know that VOO, okay, the S&P 500 ETF, that one, the expense ratio is not even it's 0.0 something. I can't remember how much it was. But the point is, first thing, expense ratio can be high, which will eat into your returns marginally. But the next thing is that you will see a spread. Okay. So in other words, right, there'll be quite a significant gap in terms of the buy and sell price. Okay. So you need to be aware of that. Okay. And other risk ETFs that may be available on the market, these are just some of them. Okay. Again, I think this is terrible. You buy a REIT, if you buy a good pricing, you should really expect 5% yield or better. But 4 point something doesn't cut it. And all these are too small. Okay, if you ask me. Spread is also quite terrible. And yeah, I wouldn't buy it personally. But you can use it. You can see the top holdings and then take a look. Okay, even going back to this, you can see all the top holdings. You roughly know what are the more good REITs good REITs that the REIT managers are looking at. And of course, you can then after that decide to buy yourself, like if you want to. Okay. But I mean, sometimes maybe capital is not there, then you really do have to buy the ETF. Or you could buy a unit trust, but I'm from Philip, and I'm just gonna tell you that don't buy this. The yield is not fantastic, but use this as a proxy to ask yourself what REITs are, favored out there. Okay, but again, this fact sheet is from more than a year ago, so please retrieve the latest fact sheet and take a look at it. But I can say that I don't think there's too much shifting. Maybe some of them will drop out due to the REIT price, going down. Maybe the Capital DC REIT should have fallen already. But you can see some of the good names there, and these are probably the ones you want to focus on. Okay, so in conclusion, okay, I think the key factors I covered. You definitely want REITs in the billions, okay, if where possible. There are quite a few REITs that have a market cap of a few billion, and you should start from there, if you ask me. Okay, and preferably the top ones in their own sectors. Okay, but if you construct a REIT portfolio, please remember that you can't just buy one REIT. Not even a diversified REIT, you can just buy one and get away with it. You should always have a few. So 4 to 5 REITs, eventually you build towards that. And if you are okay, who forgot to unmute? Thank you. Okay. Anyway, I was like, okay, if you have risk-taking appetite, okay, then tactically you can look at maybe up to 3 REITs. Okay. When I say risk-taking appetite, some people tell me that I would like to I would like to bet on Manila US REIT. Okay, go ahead, but sometimes things may not turn out the way you want it to. Okay. And lastly, REITs, as we always say, as part of overall portfolio diversifications, this is in a way split between safe and risky, but REITs definitely belongs in risky assets. Okay. If you have sorted out your baseline correctly, then whatever risk you take, even if the worst happens, you lose everything, you can still sleep easy because you know that you have your incomes coming in from safe assets. Okay, so that's always the one philosophy we talk about. Okay. So to answer some of the questions, okay, this question was quite popular. A lot of you asked which REITs are on discount with good fundamentals. Okay, if you ask me, I think right now there are a number of good Capital and Mapletree and Fraser REITs that have come out quite recently, and fundamentally, I don't think any of these 3 sponsors is doing anything terrible at all. I would actually, I think the real headache is really deciding which one you want to buy, right? Because if you have limited resources, then you may not be able to spread. For example, I recently entered a position in one of the Fraser REITs, but I also wanted to buy Ascendas and more CICT, but no money. So what's more important, I feel, is that you make sure you got your watch list first. So maybe let's say you have REIT number 1, number 2, number 3, number 4, number 5. Okay. Whatever the REIT is, okay, ask yourself, okay, if it has good fundamentals, then you put in the list. Then after that, on discount, you just look at the price to book ratio and you compare that against historical price to book. So for example, I think Mapletree Logistics has come out quite a fair bit. I think it's slightly under price to book right now, which is a price that we've not seen for quite some time. I think the last time it was that low was COVID. So if you are then looking at this, then it is possibly time to add, but please don't throw everything in, because it could drop further and you feel very bad if it does. So buy a bit. Maybe buy the first three you have. And then if number 2 is also come down already, you can buy number 2, number 3, number 4. So in this way, you slowly build positions across a few REITs. Okay. And then after that, if the price goes down further, you can add on to them again, depending on which one is you favor the most. So I know CICT is pretty down right now. Ascendus is down. Mapletree Logistics is down. All these, I feel, I would say they are on discount, but they are not on those. Okay, on discount, but not massive discount yet. Massive discount, I think you really have to wait for a very big market event, which I don't see anything like that happening, at least in the next 1-2 months. But they're definitely on discount. It's like when you go to, any of you been to Donkey, after 8 o'clock, all the bento set go on discount. Then after 9 o'clock, if they're still unsold, they go on further discount. So now I would say it's a discount period. It's not a further discount period. But when the further discount period comes, if you have that patience, you will be rewarded, because you will really be able to scoop up fundamentally good REITs at very good price. Okay. So the Mapletrees, you ask me, the Mapletrees and the Capitals and the Frasers, most of them are what I would think are on discount right now, just not very, it's not a fire sale, it's just discounted off their usual pricing. Okay. Next question, is REIT a good investment asset during interest rate cut? Okay. Because interest rates have a impact on the interest that, the amount of interest that the REITs need to repay. So naturally, if you read most of their business updates, presentation slides, they will always, sometimes there's a line that says that every how many percent increase in interest rate will represent how many percent drop in their DPU, or how many cents or how many dollar drop in their DPU. So definitely during interest rate cut, you can expect that REITs, their DPU will drop. In fact, some of the REITs I'm holding, the DPU has dropped. If the DPU can stay constant, that is a very good REIT already. You can go up, it's even better, right? So like CICT, which I personally have a stake in, the DPU actually increased in the past year, right? The most recent results, they increased year on year, they increased. So I think that's actually a very good thing. Okay, it's just that as interest rate remains high, you're definitely going to see the price under pressure, which is why it's below its NAV right now. Okay. Now, here's the thing. If you believe that the interest rate cut will eventually go away, that eventually, sorry, not what am I saying? You believe that interest rates will eventually cut, then REITs prices, which are depressed now, okay, it can be a good time to buy up a little bit, okay, which is my philosophy, my take, which is why I bought some recently. So they always say that all businesses are good businesses at the right price, right? So you have to ask yourself, this REIT I'm looking at, is it a good price? If it is, then it can be a bit hard not to be fearful that it will drop further. But if you don't go in, then when will you ever go in, right? So if it drops further, then I would suggest you can double your position or something. So all in all, a good REIT will probably be a good asset to buy in right now during the interest rate cut. That is my take, okay? Because once the interest rates, before the interest rates start to get cut, so now I would say, but once they start to get cut, I think you will see that they will rebound. And then what will happen is the banks will suffer after that. But that's another topic for another time. Okay, what are important metrics or risks we should focus on? I've said some of them, but just recapping a bit. Sponsors, okay, you need to look for good sponsors. You need to see their trend for the NPI, net property income, the distribution. Okay, their gearing shouldn't exceed 40, even though the mandated maximum is 50. You want good interest cover. And of course, you want to make sure a REIT has a lot of properties, such that if anything happens to one property, you don't have to worry that the DPU is affected. Okay, so this is what I can share. Okay. how to select quality REITs. Same thing, go through those criteria that I mentioned. But one thing to take note, because this question says SG REITs, I'm not sure you're talking about REITs that only have property in Singapore or REITs that are listed in Singapore. If it's REITs that only have property in Singapore, then okay, I think you probably have those criteria. There is REITs that is listed in Singapore but have properties overseas. The tricky bit about that is that with most of the time, if you haven't been to their property overseas, there's no way to tell how it's doing. They can always paint a rosy picture in the presentation slides, but it may not be easy to tell how the REIT is going. So if you are thinking about buying a REIT that has properties overseas, I would say that please ask for a higher yield, because that is really to compensate you for the higher risk that you will have to take on. So for example, if you would buy REIT A, which is fully in Singapore at a 5% dividend,
什么？
REIT,
不
hello,
用不用，反正
hi,
糟
can you
糕
mute。yourself? Thank you. Okay, if REIT B is the same sector, but it has overseas property, then you probably want to ask for 6% yield, okay, to compensate you for the added risk that this REIT has property overseas. So this is just one way of looking at it, okay? So, yeah, and of course, check all the metrics as I mentioned. Okay, it is time to switch from T-bill to S-REIT now. This is an interesting question. Why? Because T-bills is a guaranteed instrument. REITs is a variable instrument. Unless your intent was to park money in T-bills, then switch it to REITs, right? Then yeah, you could start to switch over now while they remain slightly depressed. But if you wanted to have guaranteed returns on T-bills, and then that T-bills will eventually come down when they cut rates, and you want to retain the same class of income, meaning guaranteed income, then please don't be switching to S-REITs, right? You should have money separately set aside for that. So that's my take. I would rather just switch it over to things like annuities and good bonds, okay? SSBs is an alternative, but long run, it's not a long-term instrument. Okay, so that is my take. I think people should start to move now. If you ask me, honestly, I felt that the first rate cut should have come in May, but now we know it's going to get pushed back. You have 4 months or so before August, September, where the first rate cut is likely to come. All I can say is, based on what I've seen, most people procrastinate. You don't start to move now, you end up stuck. And then when the rates get cut already, then you want to move, market move already, you have missed the boat. Okay, so you cannot move when the market is moving. You have to move in advance of the market, or else you will just get caught up. Okay. Okay, we are receding and will share prices return to their peak prices. Okay, the second part is slightly easier to answer. Okay, long run, I would think that good REITs will likely to exceed their previous highs. Okay. It's just that in this short term, everything is depressed. It doesn't matter what really is, they're all depressed right now. See, so I feel that REITs are probably going to be range bound for a while. The interest rates will not unlikely to raise further, but the cuts are not coming. They have been in this environment for the past 1 year plus, so likely they will still remain range bound up and down. So every time they go down, it's an opportunity to buy, right? Okay, but when the interest rate get cut, okay, then you will start to see some recovery. And then that's when the share prices will probably move up again. Okay. But only the really good REITs will start to exceed their peak prices. Okay. So not every REIT will return to their peak price. Okay. So the better quality ones are likely to have that chance. Okay. This one I think I somewhat covered it. So you see a lot of questions about interest rate. Yeah. Every increase in the interest rate, every percent point increase in interest rate will affect how much interest they have to pay, which affect their payout. So long term, however, I don't see interest rate remaining at this level. So once they come down, I think REITs should recover nicely. Okay. Of course, the stronger REITs being the ones to recover better. Okay. Okay. Is it a good time to buy REITs now? Okay. So a lot of people asking when to buy REITs. I feel like if you are able to stomach further drops, right? Because it can happen. Go ahead, buy some now, don't throw everything in, and you may want to average in. If you are not so adventurous, then you may want to wait for the interest rate cuts to start before you start to buy in. Okay, but my opinion for buying Lion Philippe S-REIT, personally, unless you're very lazy and really don't want to do anything, I think you'd be better off buying individual REITs, good ones lah. Okay, yeah. So that's my thing. I personally did not buy Lion Phillip S REIT. I feel like it's not too hard to do that. To find good REITs. Okay, best REITs for retirement income. Again, as we stress, you need to analyze them and look at the ones with good sponsors, good numbers, good metrics over the years. Okay. Okay, hang on. I saw some text inside. Wow. Okay. I think Chung Wee has helped me to answer some of them. So thank you, Chung Wee. Okay, Mapletree Pan Asia. Someone asked about Mapletree Pan Asia. Mapletree Pan Asia is interesting because it's already quite badly beaten down thanks to its Hong Kong position. If I remember correctly, but it's still strong due to Mapletree Business City and VivoCity lah. I did talk about Mapletree Logistics. So Pan Asia, I think it's probably something that I would look at if I can't find a good entry price for my other REITs. So I would say personally, it doesn't rank very high in my must buy. I'd rather look at, say, Ascendas, Mapletree, Mapletree Log, Frasers, Log, CICT, these few REITs. Pan Asia is I won't say it's a bad REIT lah. It's just not very high on my priority list lah, but you can consider it. Ascendas India Trust, okay. I'm not too familiar with this, so sorry, I can't really comment on that. Is Kappa a good sponsor? I think Darren better suited to answer this one. Okay, so it is coming to 9:30. Darren, do you want to wrap up and maybe take 1 or 2 more questions?
Okay, can.
Yeah. Thank you, everyone.
Okay. I think we can't answer all the questions, but I try to answer most of the question already. Okay. As this is only about 1.5 hour session. And now all the REITs result most of them are out already. Okay, except coming week, like coming Monday, Mapletree Logistics Trust will have a full year result coming out. Okay. So for this actually I planned 2 REITs webinar. Okay. So that will be in May. Okay. For example, I think next week I'll talk about just 2 hours, just purely talk about retail REITs. Singapore retail REIT. Then we'll talk about CICT, Paragon, Fraser Centrepoint, Suntec, okay, and Sahil Global. So if you can extend look at it. Another common question asked is Mapletree, especially now Mapletree Pan Asia is performance not that good. Okay, there's a question asked. So I'll do a seminar just talk about the 3 REITs because they have their full year result out. Okay, MIT just out yesterday. Mapletree Pen I think out a few days ago, and Mapletree Logistics Trust holding out next Monday. So after all their result out, then I can take do a webinar 2 hours just purely talk about the 3 REITs. Okay. And someone else asked me Kappa REITs is it a good REITs? To me, when it comes to REITs, you always look
Good
at the
sponsor,
track
not good REITs. I think the question was whether is Kappa a good sponsor.
Okay, is Kappa a good sponsor? I would say that it's a better sponsor than some of the other sponsors. Okay, but you ask me to look for most ideal one, I will still prefer capitaland and Mapletree. Ultimately, capitaland and Mapletree are property specialists. Okay, Kappa is not a property specialist. The Kappa Corp is a diversified industry. They got oil and gas, now they cut it off. They got power generation, they got telecommunication, and they got the former capitaland. So for them, it's a diversified business. Okay, so the CEO need to look at all the business aspect. Okay, but for capitaland and Mapletree, very clean cut is they only need to look at properties. Okay, and thus when look at sponsor, I prefer a sponsor to be a specialist in properties. Okay, and that, so I cannot say Kappa is not a lousy sponsor, but in terms of specialization, I think that's my personal, they are lagging behind capitaland and Mapletree. Okay, so I'll not bring them as a tier 1 REITs. I'll actually rank them as a tier 2 REITs, but better than those tier 3, tier 4 lousy REITs. Okay, so that's my view on Kappa REITs. And also, unfortunately, look at capital risk performance is not really that fantastic over the years. Okay, it's not really that fantastic. I think CICT, the former CCT, CapitaLand Commercial Trust, I think perform better than capital risk. If you were to do apple-to-apple comparison, both are office building focused Singapore. You look at the former ex-CCT, you have able to retrieve the data, you will able to see that all the while CCT perform better than capital risk. Okay. So this is the feedback, and we'll, if you got any comment, you can just type on the feedback. And you want to contact us, you can just contact any one of us. This is our contact here. Okay. And now it's 9:30, so we want to end on time also. And we thank everyone for attending the session. Okay, if you got any question, you can contact us separately. Okay. Good night, everybody.
Recording stopped.